Welcome to Financial Minds and Happy New Year. We are kicking off season 5 with our two favorite Vizo financial economic gurus, Tim Sustak, SVP Chief Treasury Officer, and Scott Wood, SVP Chief Investment Officer with Vizo Financial. The Federal Reserve meeting is next week. What will the Fed do next, and what impact will it have for credit unions? Let's find out. So, Tim, what are the key economic signals you're watching right now, and why do they matter to credit unions?
Okay, Jamie. Yeah, I think I'm going to say the big things the Fed is watching, right? Labor and inflation, and I think for credit unions, two reasons. Number one, right, those goals are intention, and how those play out is what's going to affect where rates go, which is very important to credit unions. And those two things also speak to the health of the consumer, right? I mean, if everybody has jobs, the job picture is promising, consumers are certainly more willing to spend. Likewise, if prices are not aggressively going up, people are feeling good. Their dollars are still worth, what they were hopefully a few days before. They're more willing to spend. So I think those things really go not only know what the Fed is going to do, but the health of the consumer. Looking at labor, we're starting to get some data in. I think, Scott talked about this a lot last time about the interruption of data given the government. Uh, you know, and we've got some of that back. We don't have all of it yet. You look at payrolls, they went up about 50,000 for December. Latest reading that came out, the unemployment rate sitting at about 4.4%. October, November payrolls revised down 76,000, lower than originally reported. So, although we're still, we grew a little bit in December. I think overall, you can have some arguments, and Chair Powell mentioned it as prior meeting. Depending on margin for error, you could say maybe we're not growing at all in the job arena. Unemployment's been, call it fairly steady, but it's been climbing somewhat. 4 to 4.5%, 2024 and 25. Latest reading, like I said, was 4.4%. So, job creation has definitely slowed. I mean, you hear the Fed talking about the inflation and job picture mandate being in tension. The risks at this point are probably tilted a little bit more towards the labor side. You also heard talk about the fact that even though, job creation has certainly fallen, the labor force supply has also fallen, right, with things like immigration and participation in the labor force. So, those things have kind of combined to make it a kind of palatable and gradual slowdown without employment falling off the cliff. That's a concern. Could we get in a situation where things get worse? And I don't think that's what is foreseen, at least by the Fed anyway. So we're still in kind of that controlled, uh, constriction of employment. On the inflation side, we're still lacking some data there. Right, CPI for December, the headline, 2.7%, 2.6% for the core. PCE, which is the Fed's preferred measure, still the latest I could find out there is 2.8% for September. So we still don't have that information. Um, to this point, tariffs have not been a real issue, certainly not what has been feared. So we'll see if that continues. Um, the other thing we're kind of watching, obviously, is all of the geopolitical events that are going on, and certainly not going to get this isn't a political podcast, but to say there's a lot of moving parts going on is a very large understatement. So, you know, we will see. We've got some additional tariffs maybe being floated out there, and that picture is very murky at this point as to how some things will play out. We'll probably talk about that more as we go through the podcast. But right now, stay peeled to labor and inflation. We'll see where that goes and how all the extracurriculars may factor in. So.
All right. Well, thank you. So, Scott, what do you think about the labor market? How's it shaping inflation expectations, and what might that mean for interest rates?
Yeah, as Tim pointed out, there's a lot going on. the labor market has been weakening, depending on how you look at it. But I mean, the unemployment rate has been climbing. The number of new jobs created has really all throughout most of last year and even part of the prior year were pretty abysmal with all the adjustments. So, I don't think you can make the argument that the labor market is anything but weak. Um, it's weak. We are starting to get some of the data catching up on the labor side of things, but on the inflation side, unfortunately, we're months behind still. So the government shutdown really it created a little bit of an issue for us in the markets, but also for the Fed and interest rates. The Fed, they're really kind of evenly split into two camps right now. One that's very concerned about the weakening labor market, and the other camp is very concerned about inflation. But so far, as Tim pointed out, when you look at the latest readings we have, which are a little dated, we're under 3%. When you look at the employment data every month when they come out with the employment numbers, unemployment rate, and the number of jobs created, they also come out with wages, wage growth. So wage growth, I think the last reading was 3.8% year over year. So wage growth is tracking higher than the 2 or 3 months ago of inflation data. That's positive for the consumer, not necessarily positive for inflation, because certainly if wages got too high, then that could lead inflation higher as people have excess money. But that's not a concern at the levels we're at today. When you look at University of Michigan, they do inflation expectation readings. The good news there is if in the middle of the year, those expectations for 1 year out and 5 year out were really high. And I think we talked about this on one of the podcasts that it seemed unnaturally high. It didn't seem um, logical at all. If you look at it from a logical standpoint, that we would ever get near those levels, and we haven't. And they've since come down. So when you look at they've come down. They're still elevated though, especially in the 1 year. So the latest reading for 1 year inflation expectation by consumers is 4.2%, which I think is still high. But then when you look at 5 years out, they're in the 3% range, a little over 3%. So that's better, and I think that's where we're going to be. Somewhere close to 3 or maybe even under if tariffs and some other things work in our favor. Tim talked about tariffs. They haven't really had a major impact yet on inflation. The San Francisco Fed they did some research and they came out and they looked at tariffs over, decades and many administrations. What they found is that tariffs have, what they saw was actually negative impact on inflation. It actually brings inflation down. And the reason why is because consumers start to stop spending because prices go higher, or they start, moving to substitutes, which is, econ 101 type of stuff, right? We substitute when you look at beef prices that are really high right now, what a lot of people have done is that, they've substituted. So they're buying some other protein, chicken, pork, or whatever else that's still reasonably priced. So, um, so the good news is inflation hasn't gone crazy because of tariffs or other reasons. Wages are above that. Now, I think the quandary we see right now is the consumer. We keep hearing about this K-shaped economy. We see these people that have good earnings continue to spend to the point where, they say that the top 10% are supporting half the economy, half the spending right now. And if you go to the top 20%, it's, even higher amount of the economy. So they're the haves and the have-nots. So the paycheck to paycheck folks are still struggling. And it's really, I think, it's been going on for years. We've been talking about this for years. Um, so that's the real issue. Are they going to continue to struggle? I think the answer is probably yes. We will for the foreseeable future anyway. Things could change. There's some positive potential things in the coming up here, like this year that we could see with different things. And we could talk about those later, or maybe in the podcast if that comes up. But yeah, that's the good news is wage growth has been higher than inflation growth. Positive for the consumers. But again, the quandary at the Fed is still this split group. One concerned about inflation, which, to tame inflation, they would raise interest rates. And then the other group that's worried about weakening employment, and to help with that, you're lowering interest rates. So they're kind of opposite sides of the spectrum, opposite things to do to resolve that issue. So that'll have to be worked out. So it's a healthy debate at the Fed, and I think it is in the markets too. Which one should take precedence?
Yeah, it's interesting that you talk about, the divide between the have and the have-nots. I think I've shared with you guys before, my sister works in healthcare and she manages the teams that, clean the house, clean the rooms. And she's really struggling, number one, to get people. And then number two, the people that she does have, like she ran into one of the managers and he was working at Giant. And so when you talk about, here's a man that has a full-time job working in healthcare, but then he still has to supplement his income by having another job at one of the local grocery stores to subsidize, for his family. And so, like, it
Yeah.
breaks her heart to see that. And she's doing everything she can to have programs in play. But then she's running into the same issues of trying to find people for the positions too. So, everything you are saying, I'm hearing from a personal side, with my family. So,
Yeah, I
Yeah.
just got done reading a story that talked about, certainly as Scott mentioned, the K-shaped economy, and that even, inflation, and not from the standpoint of, um, you know, just dollars and cents, but the percentage of, the lower income person's spending is going towards things that have risen the most. So even the effective inflation is tilted against, those that aren't doing as well as, like Scott said, the top, 10 or 20% that seem to be driving everything at this point. So, you wonder if it comes to a point, and I've read some stories about that too, and economic news about, you know, the statistics that we use, are they tilted so much now, you know, based on what that top section of the economy is doing, the more the haves, and as far as consumers go, you know, are the have-nots really not materially impacting the data anymore? And that's a dangerous thought,
yeah,
when you think about that. So.
yeah,
Yeah.
absolutely. So, Scott, when you look at all of this data, what do you expect the Federal Reserve's next move to be on interest rates?
Yeah, so at next week's meeting, we don't think the Fed's going to do anything. I mean, the markets don't either. I think the odds are basically as close to zero as you can get. I mean, they're giving 0% odds. And honestly, the markets don't think we're going to see anything. When you look at where they give 100% certainty, they think the Fed may cut rates at the July meeting.
Okay.
Um, and by July, the July meeting, well, I say we'll have a new Fed chair. We should have a new Fed chair. We'll have to see what happens there because Powell's term is up in May, and then obviously somebody new will have to be confirmed by the Senate. Um, with the revelations, Chairman Powell came out a week or so ago and publicly announced that he was under investigation by the Justice Department. So that upset some senators. Um, who said they're not going to vote on a new Fed chair until that's resolved. Tom Tillis of North Carolina, where I live, is one of the ones that had come out and said that. So we'll have to see. But assuming everything lays out and happens the way it should, we should have a new Fed chair in June and then potentially a rate cut in July. We'll have to see though, because you're just replacing one person. And Powell has been, we wouldn't have rate cuts over the last, end of 25 and the end of 24 had it not been for Powell. If he was against rate cuts, I'm sure we wouldn't have seen what we saw. So I don't know that's going to change a whole lot. Now, can a new Fed chair influence folks, in June or July to maybe vote in that direction? And maybe there'll be data to back it up by then too. Maybe we'll be caught up and the data will be clear. No move at the next meeting. We don't think the Fed is likely to be on hold for a while, and they're probably going to use the data dependent data that they've reasoning as they've used for a while, but also they could use this that we're behind on data. We're waiting for data, and as Tim pointed out earlier, we have potentially new tariffs coming with this fight over Greenland, and and other things with um, some of these countries with oil and everything else. So there could be more tariffs coming. The markets still trying to to figure all that out, and I am. It's hard to keep up with it. What's a threat? What actually happens? But yeah, I Fed on hold for a little while anyway, as kind of what we think is going to happen.
Okay. All right. So Tim, as far as liquidity, what trends are you seeing in liquidity across, the credit unions, and how should institutions respond?
Yeah, Jamie. Well, the good news is there's not much of a story here, which is
Okay,
always a good thing
good.
when it comes to
Yeah.
liquidity. They're the worst kind of problems to have, and right now, for most, and certainly there are some credit unions that are struggling. We're talking in general here. I think for most credit unions, liquidity is certainly isn't the issue right now. Gosh, you look at our balance sheet at the corporate. And lending has been very slim for the past year. Deposits, have been very stable for us, elevated to where we would normally expect them to be. So it appears as though credit unions are doing pretty well on the liquidity front. I mean, we actually asked that question in our quarterly economic update that we did. Just ask credit unions that were on the call, hey, how do you feel? Will liquidity be better in 26, worse in 26, or you just don't know? And the significant majority said, hey, things should be fine in 26. So I don't think there's a concern out there right now. Having said that, to your point, what should they do? I think the best time to plan for a liquidity issue is when you have no liquidity issues, right? I mean, we've all heard that before, and it's certainly the truth because you don't want to have to come up with new weapons in the heat of battle. So I would say, particularly with what we're talking about during this podcast, there are so many unknowns out there. There are so many moving parts flying around that to say that any of us know with any certainty exactly how the picture is going to play out or anything else, I think is, kind of obviously crazy, right? I mean, there's a lot going on. So my thought would be just, stay on top of liquidity. Don't make any, we saw a lot of credit unions get in trouble in COVID times because before the Fed started raising rates and we had that 500 basis point increase over 15 months, that didn't want to hang on to the cash and kind of put it all out there. And unfortunately, the Fed whipsawed us, and it was kind of exactly the wrong time, right? And I would just say, remember those times, when the money's kind of burning a hole in your pocket. Not to say you shouldn't put some out there. We all need to earn yield, but by the same token, as we've been shown recently, it never hurts to keep some powder dry, and especially during uncertain times. So if you've got some liquidity solutions that you haven't really acted on yet to get in place, get those in place, get prepared just in case, and do it while you can right now before we have the next liquidity event. Because we all know the cycle rolls, so it'll be back, unfortunately. Hopefully not for a while, but we'll all have to deal with a liquidity crunch again. So.
All right. Well, thank you. So Scott, if you had to pick one metric for every credit union financial leader to monitor closely this next quarter, what would it be and why?
Yeah, that's a tough question because there's so many things like inflation and consumer spending and employment that all bear keeping an eye on, and they all have various levels of concern. But I think I'll kind of segue off of some of what Tim said and liquidity and maybe some things that could have a positive boost to liquidity early this year. And that's tax returns. We've heard a lot of talk that tax returns. I think the average return last year was around $3,000, across the board. This year, the projections are $4,000. So that's about a 30 some odd percent increase over last year. As Tim mentioned, liquidity held up very well last year throughout the year and really for the last few years. But last year held up pretty well. Not a lot of movement. If we see these higher tax returns, then I think one is to track these returns that come into your credit union, and then two, see what happens with that money. Does the money sit? If the money sits for a while, then that's an indication that your members think the economy, or they're a little concerned about the economy. On the flip side, if people start spending new cars or used cars or whatever it may be, some toys, a boat or RV or something, then it could be a sign that people are feeling pretty good about the economy and that that next year is going to be a good. Well, I'll say next year. We're in 26. That 2026 is going to be a good year. So I think it'll be a really good indicator of, are those deposits higher than anticipated? I think that's going to be the case because some of the tax law changes with Social Security recipients and others are going to get some tax breaks, as well as small businesses that can do some immediate expensing and things like that. So I think their members are going to directly, by how they treat that money, let the credit union know what's going to happen or what they think, how they're feeling this year. I think that's, you can look at all the surveys that all these different firms and companies do, but I think that's a huge indicator of what's going to happen in 2026, is how they are with that money. So I think that's what I would kind of keep an eye on in the first quarter. I think it could be pretty important.
All right. I'm going to go back to tariffs. Both of you mentioned tariffs. So, and I know you said there's not a whole lot of news, but Tim, are you seeing or hearing anything else about tariffs and the potential impact to the economy?
Yeah, so there's some other things we haven't talked about. Some things we have. As you know, there's a lot going on in the tariff world, and it changes fairly frequently. As Scott talked about, right? It's really tough to measure the impact of tariffs. There's lots of things that are going on there, not only with tariffs changing, negotiations change the initial levels. There's other things going on in the economy that may affect certainly prices and things. So it's hard to measure exactly what the impact has been. I think it's safe to say at this point that the impact has been smaller than initially feared, right? The key is why is that? Like as Scott said, there's some evidence that tariffs may not be inflationary at all. I think there's some evidence out there to say that in this instance anyway, because it was something that was announced and everybody could see coming, there was certainly a run up in inventories to get a hold of goods before those tariffs took place. So, certainly there's evidence to say businesses have been absorbing a lot of the tariff impact to start and not passing it to consumers. Is that because they had a lot of inventories, stocked away at old prices before tariffs? Is it because they feel they don't have the pricing power? Hard to say, but I think the way they're going to react in 26, will be very interesting to see if we see, some of the increases we were looking for. I just saw a story, CEO of Amazon, Andy Jassy, came out and said, hey, starting to notice some prices rising, and that, talked about the inventory build, and that, that's, pretty much gone now. So we'll see. We'll see what shows up. Then on top of that, you've got the Greenland tariffs, which Scott mentioned. That's out there to say, hey, for the UK, Denmark, Norway, Sweden, France, Germany, the Netherlands, and Finland, if there isn't a deal reached on the purchase of Greenland, then there's a 10% tariff on goods that'll go in February 1st, and then 25% on goods starting June 1st. So that's another factor. Well, obviously that's going to change. It's going to ebb and flow, similar to the initial round of tariffs we saw, being announced on Liberation Day, right? There's going to be negotiations that take place. We'll see what ends up happening there. And last of all, I think, we've got the Supreme Court decision on the legality of all the tariffs, which will not only be the previous tariffs announced, but then it will be the same thing with the tariffs that we have in Greenland. And I saw last night too, just for good measure, that overnight it was announced that there'd be a 200% tariff on French wine and champagne. So you folks that like French wine and champagne, watch yourselves, stock up now, because it may get very expensive. We don't know. But the Supreme Court as of yet has not ruled. There were some announcements that came out today for decisions from the Supreme Court. The tariff case was not in those releases. So the thought is, hey, it could be later this week, or it could be weeks until we know for sure. I think the caveat to that is, no matter what is decided there, whether it's, say, all's well, keep forging forward, or you know what, no, they were not legally implemented. There'll be some transition time, but there seems to be certainly other statutory authorities that the administration could use to say, hey, okay, if those are null and void, then we'll reinstitute the tariffs under these powers. That'll be less controversial. So, we'll see what happens there, but that's kind of what's happening on a tariff front. And that information is only as good as long as this podcast is on, because after that, you don't know. It does change frequently, and keep your eyes peeled to the news.
Yep. I will be sure to get an update the next time the three of us meet. So this might be a recurring item on the podcast, along with the
Absolutely.
next one until a decision's made, Scott. So I'm going to ask, I know you mentioned a little bit about Chair Powell. His term is up in May. Are we seeing any, front runners? Do we know who's going to be the next chair? Like what, could you give a little more insight there?
Yeah, it's been an interesting run of who's going to be the Fed chair. I think it changes minute to minute and month to month. And I think last year we kind of felt like we knew who it was going to be. And really, then it was kind of maybe a two-horse race. The two Kevins, we kept hearing that. Kevin Warsh and Kevin Hassett were the potential folks. Recently, Scott Bessent, Treasury Secretary, came out and said the Senate will be happy with any of the four candidates that they're looking at now. So there are some new entrants to the game, or some returning entrants, I guess. So what we thought was one of the Kevins to win maybe has widened out a little bit. So Trump, he had some interesting comments recently. Kevin Hassett is the National Economic Director or Council Director. Trump said he really likes him in that role, even though he's considering him for Fed chair, because he likes the way that he explains the administration's economic policies to the markets and to the street and to the reporters. So while he looks like a great candidate, he may be excluded because he wants him in this other position, or to remain in the other position. And then he said about Kevin Warsh he made some comment about what a good looking guy he was, and something along those lines. And I thought was kind of interesting. I guess he likes to surround himself with what he considers as good looking people. Who knows? But Kevin Warsh is another potential, and I think he has some ties to the Trump family too. He's a very viable and likely candidate that could get the nod. Christopher Waller, who's on the FOMC right now, is another one that could potentially get it. Although I would say he's probably, of the four potential candidates, he's probably at the bottom, unless they have trouble getting a Fed chair confirmed, and then maybe because he's already on the board, he would be an easier confirmation type of thing. And then the one who we've heard a lot about here recently, Bloomberg had an article a couple of days ago saying that his stock is rising quickly, is Rick Rader from BlackRock. So he's kind of the wild card that we hadn't been talking about him at all, and he's recently entered this kind of race, and he's gained some momentum apparently. So I would say at this point, any of those four, but I don't get the idea based on Bessent's comments that Bessent and Trump, and ultimately it's going to be Trump, right, have made a decision on who this one individual is going to be. Which of these four, assuming these are the four, no, he didn't say that these were the four candidates. It could be somebody else. Michelle Bowman is another potential candidate on the Fed that could be the Fed chair too. So kind of aligned with Trump and put in there with him. So, but I would say the two Kevins and now this BlackRock Rick guy that have some momentum could be in there. So, hang on, because they told us last year that we're going to make an announcement. It sounded like early this year. It's kind of like Tim mentioned about the tariff decision by the Supreme Court. We're all kind of been waiting for these decisions to come, and they've been delayed. But they have until May, so they may take a little bit of time to get there. But those are kind of the four leading candidates at this point in time.
Okay. Well, I'll be sure to get an update on the next podcast with tariffs and this as well. Sorry, Tim.
I'm sorry. I was going to say, I just saw a story on CNBC that Bessent came out and said that they could have their pick as early as next week. Oh. So who knows if that's the case, but He's been willing. He was willing to float that out there today. So
Okay.
Yeah, and I think the markets would like it, right? If the Fed came out, or if the administration came out and said, "Hey, this is the person that's going to be the new Fed chair. We're going to nominate." They'll need time to push it through because, like I said, there's a little bit of animosity right now between the administration and some senators who will have to confirm uh, the next candidate. So that would be nice if we get it. Did that article mention anything about a front runner, Tim?
now, you know what, Scott? I didn't see anything. Just kind of what you mentioned that the four finalists were not named, but previous comments they say they talked about the field of five that you talked about. Hassett, Warsh, Waller, Bowman, and Reader. So exactly, they're aligned with exactly what you said. So
Okay.
So we'll see. Yeah, maybe next week. That'll be
All right.
awesome.
Well, thank you both so much for joining me today. Interesting conversations. Still, I think what'd you guys coin last year? What was the word? Uncertainty. Are you still sticking with uncertainty for at least this first quarter for a bit?
I am hopefully optimistic. I think at
Okay.
this point, with everything that's happening, but
So we're going from
GDP's been
uncertainty
pretty
to
strong.
optimistic.
Yeah, GDP's been strong, and we didn't talk a lot about GDP today, but fourth quarter is going to be weaker. Still going to be positive, but weaker than the third because of the government shutdown. But we could have a really strong first and second quarter. I think the other thing we didn't talk about was all this potential foreign investment. Trump's thrown out there 10 to 20 trillion dollars. Now, what actually comes to fruition, who knows? But if we get some of that in this country this year, and then all these tax things, so I'm hopefully optimistic. So I'm going to go from uncertainty to hopefully optimistic.
Okay. All right. All right, Tim, any final thoughts for our listeners today?
No, I'll go with the hopeful. I'm still feeling like there's a lot of uncertainty. There's just so many things flying around. But final thoughts. I think just kind of what we talked about in the liquidity section. We're obviously moving into the time of year where most credit unions get pumped up with liquidity. I would just say, don't and anybody who's watching what's going on in the world and politics and the economy. I mean, this is obviously I think what everybody would think is you can't get married to any one scenario, right? Especially as you're managing your balance sheet because there's so many uncertainties right now. I'm still, like I said, a little maybe more in the uncertain camp than Scott is, but I just feel like there's a lot of good things that certainly could happen, and I just think there's a lot of torpedoes flying around too. So stay nimble is I guess what I would say.
All right, Scott, any final thoughts?
No, I think Tim's right. There's certainly a lot of potential things that could go wrong, a lot on so many different geopolitical and fiscally, and the stock market is way overvalued if you look at normal metrics. So there's a lot of potential issue. But I feel that, but I'm gonna stick with my hopefully optimistic for now.
All right. Well, thank you both so much for joining me today. Really appreciate the discussion and your insights. Also, don't forget to subscribe, share your thoughts, and stay tuned for Vizo Financial's post-Fed meeting analysis with Tim's FOMC update. Also, special thanks to Vizo Financial's Financial Strategies Workshops for sponsoring today's episode. The dates are set for Vizo Financial's 2026 Financial Strategies Workshops. They are March 19th in Hershey, Pennsylvania, March 26th in Richmond, Virginia, April 9th in Greenville, South Carolina, and April 14th in Pittsburgh, PA. Registration is open. More information is available on Vizo Financial's website at www.vfccu.org. As always, thanks for listening and make it a great day.